I'm joined at the desk now by Chris Meyer. He's the CEO of RMB Morgan Stanley. He's our go-to guy for all things economic as well as market related. But interestingly enough, you mentioned that one of your colleagues has been taking a look at the South African equity market quite closely. What are the trends that we're seeing there?
Yeah, our strategist Mary Curtis wrote a piece this morning talking about the South African equity market in the emerging market context. And I think the conclusion of her report was that things look better for equities both in South Africa and in emerging markets than they have done for quite some time. And I think some of what she's written about is the reason why emerging markets have rallied 5% or so in the month of March, particularly some of the double deficit nations that you would have heard about in the heat of the crisis, like South Africa, the Fragile Five. Yeah. So, I think what's driving it is a combination of factors, one of which is the more benign interest rate outlook in South Africa is driving some of the recovery in some of the more interest rate sensitive stocks in South Africa. But also just in emerging markets overall, what we're starting to see is some signs that the deficits, both the fiscal and the trade deficits that some of these double deficit nations have historically had, are starting to correct. It's correcting in India, for example, quite rapidly as their imports contract. And even our latest trade figure in South Africa, which was released earlier this week for February, is showing some signs that the imports are falling faster than the exports. So some of the signs that the weaker rand is starting to make the trade balance recover to a more positive situation is also feeding into some confidence that the crisis that might have been in South Africa and in some of these double deficit nations might not be as severe as people had feared.
Aren't we a long way off though, Chris? Given the pressures that South Africa faces, the positive US growth story, it's the issues in China which impact on us as a commodity player. Are we really positioned for growth?
Look, I think we definitely have some growth challenges. We have had forever as a country because our infrastructure is relatively poor and underinvested in. But I think so you're asking me a more long-term question. I think longer term, the problem that the equity market has is an issue around growth, but also valuation. I think the South African stock market is expensive versus its own history and expensive versus emerging market equities, which is its closest peer group. So I think you're right about longer term. I think the South African equity market is going to struggle to perform very well. But in the near term, if you think about what fear existed in January and February of this year, the fear was that these double deficit nations could create a significant crisis in emerging markets as the US takes the liquidity out of the market and as China slows. And I think what we've seen in the last month, in March in particular, was that actually some of the emerging markets can muddle through as some of their deficits start to recover. China's trying to make sure that its growth slowdown isn't dramatic. All those things are positive signs for risk assets. Equities is a risk asset. Emerging markets is an even riskier asset. And so when you start getting people have an appetite for risk again, then you have a situation where emerging markets and South Africa within that can recover.
Is South Africa still on track, rather our all-share index on track to reach that 50,000 point mark?
Look, it's a good question. I mean, the nature of that index is so strange. We all think that JSE's all-share index is typical of South Africa Inc. It really isn't. 38–40% of the JSE is rand hedge stocks, 20% is mining companies. Much of that has very little to do with what's going on in South Africa. So the sort of so-called financial and industrial index is only 40% of the overall market. So look, I think rand hedge stocks could go higher because I think structurally the rand is in a difficult situation. So and as those companies have earnings exposed to developed markets, which is recovering, those stocks could do well. Mining depends on China and some strikes,
Exactly.
So if we can resolve strikes and China slowdown isn't dramatic, then I think both platinum and just general mining stocks could do quite well. So I think there's some positive signs that have come through in March, which is why markets have recovered. But I do think structurally South Africa is a low growth market. It's not really an emerging market. And it's quite expensive now. It's trading at 12.5 times forward earnings. The 10-year average is 10.5 times. So you have to really be able to believe in future growth to justify 20% premium against its history, especially when some of the emerging market crisis worries are not completely gone. I mean, they're still with us.
Exactly. Justifying those growth, the growth story there should be a difficult one.
Yeah.
Perhaps does that strengthen the case for investors to look offshore?
I think so, and we're seeing it even in our business. Many of the institutional fund managers in South Africa are investing a lot of their time and money in international markets. They see more opportunities there than locally, and even in the retail investor market. I think, unfortunately there what tends to happen is the rand weakens, investors think, oh gee, I need more money offshore. They move their money there just at sort of the wrong time because the rand's already weakened. But I do think that both from an individual investor and an institutional investor sort of asset manager market, more and more time and attention is being spent on trying to understand the opportunities in offshore markets. And it's, I guess it's good for global broking firms like RMB Morgan Stanley.
You also have interesting insights to share with us regarding a new book, Flash Boys, regarding high frequency trading. What exactly is that?
Look, it's a little bit kind of specialist topic maybe for this format, but Michael Lewis, who many of your listeners will know about, he writes a lot of books about financial situations. The most recent book, Flash Boys, is about a concept called high frequency trading, which is really just fast trading by market participants in the US market. And he's got a particular person in that book that's sort of the glory guy. But the whole notion is that, and they use these words, they say that the US equity market is rigged, okay, because the man on the street or man or woman on the street who trades through the internet is very slow, but the person, the hedge fund that's got their trading system sitting in the exchange is very fast. Or is the man on the street, again, another example of where the man on the street is being prejudiced against the sort of capitalist financial institutions. Could be an exchange, could be a bank, could be anyone. Now, the reason why it's interesting for South Africa is because the stock exchange here, the JSE, is allowing high-frequency trading from May of this year. So it's just, it's around the corner. And so I'm sure some of that sort of sensational debate that's emerging in the US because of this book, but also because there's an FBI investigation, there's an SEC investigation into this topic, will come to South Africa. And then it's up to us as market participants to explain why having one market venue with equal speed to that venue by market participants does not prejudice other market participants the way it's being questioned in the US at the moment.